Good morning, good afternoon, and good evening. I'm Diana, and I am the head of research and sustainability at GBBC, Global Blockchain Business Council. It is a pleasure today to welcome you to GBBC's virtual members forum on self-custody, technological innovations, and public policy implications. This is a bi-weekly webinar showcasing the innovative work of our members around the world. And today we are joined by Will Paul, Public Policy Lead for Small Business, Payments, and Hardware at Block. Will is going to delve into self-custody and options on market, as well as introduce Bitkey, Block's new self-custody Bitcoin wallet. He will discuss key public policy themes for self-custody, including a comparison state of play across international markets. And before we begin, I would like to also introduce Will. Will Paul is the public policy lead for small business, payments, and hardware at Block, as I mentioned, and as such, he represents interests across the Square, Cashapp, Bitkey, and Bitcoin mining businesses. He is an experienced public policy thinker. He specializes in developing, influencing, and implementing trade, economic, and innovation policy. Will joined Block in June 2023 from HM Treasury in the UK, where he was the head of trade negotiations, overseeing HMT input to the UK's free trade agenda, including deals with Australia, New Zealand, and CPTPP. We welcome your questions at any point during today's presentation for the audience, so please submit them in the Q&A tab at the bottom of your Zoom screen, and we will take them after the presentation. So thank you, Will, for joining us today. We look forward to this opportunity, and I will hand things over to you now to begin.
Excellent. Well, thank you to GBBC and thank you to Diana for that introduction. So as introed, I'm from Block. You may have heard of some of our main businesses. So Square is our what started as our small reader that helped to process credit card transactions for folks who previously couldn't access that, has now expanded into a range of tools. We also have Cashapp in the US. But we're really excited as part of our emerging businesses to be looking and working more on Bitcoin. And one of those products, one of our first hardware products that we've launched in this line is Bitkey, which is our self-custody Bitcoin wallet. So as part of that, I'm here to talk to you today about self-custody. And we're going to look through a few different aspects of self-custody. So we're going to have a quick overview of what self-custody is, the concept of self-custody, and why people do self-custody. We're going to look at some of the technological innovations in self-custody. We're very much at the start of the journey for self-custody. And there's a whole range of uses, both financial and non-financial, that will be useful for people to know about and hear as we go on this journey of innovation. I'm going to talk to you too about Bitkey, which is our new wallet that I mentioned, and outline how what Bitkey does and how it's slightly different, and as well as how it solves some of the challenges facing self-custody today. And finally, I'm going to talk about some of the public policy implications that come from that. So I work on policy. Just this week, in fact, I was in Washington, D.C., talking to lawmakers in D.C. about self-custody and the need to include that in their legislation to protect the right to self-custody. So we'll look at some of the issues that are coming up, both in the US, but also globally, the EU especially. As Diana said, any questions open to any and all, so please do include that Q&A. And if you want to look at Bitkey as we do a presentation, the website is bitkey.world, and it has all the information about the product that we'll talk through. So the first section, we'll just kind of introduce the concept of self-custody and explain some of the background. If you already know your Bitcoin, if you already know your cryptocurrencies, some of this will be more familiar, but we are starting from the beginning about concepts. So if you are new to self-custody and you're new to Bitcoin, this will be useful for you. So it's important to firstly talk about how do you even own digital assets. The concept of owning digital assets is slightly different from, say, normal fiat money. There's kind of a key thing you need to know about is that digital assets exist on a public blockchain, the digital ledger, as you might hear it. You can't take them off. You can't withdraw them like you may take cash at the ATM. That's not how it works. They always are on that public blockchain, and how you use and how you own your digital assets is through demonstrating ownership. You prove your ownership claim over them, and that's how you're required to controlling these digital assets. So you can kind of see at the bottom, I've taken a screenshot from what's called the meme pool, which is for Bitcoin, the list of all the transactions that will be upcoming into a future block. This is sort of a demonstration of somebody who has successfully proved they own some Bitcoin, and they're trying to transfer and use their Bitcoin. You can see the addresses, so they have demonstrated ownership of that address that has access to that Bitcoin. How you prove ownership is key and is all about self-custody and why we're here today. I will note quickly at the start that the way that they account for different ownership is slightly different across different cryptocurrencies. So the two big ones you probably heard of is Bitcoin and Ether. Bitcoin takes a particular approach called an unspent transaction output. This essentially means that when you have a right to an address, not the address, but you have a right to the Bitcoin, and when you use that Bitcoin, it goes into an unspent transaction output. That is very dissimilar to the account model. So the account model is what Ether uses, and is more familiar for people who use traditional banking, where you have one account that balance goes up and down, and you simply subtract the account. Bitcoin is slightly different how it works, and it becomes different tokens that you have to demonstrate ownership over, which is not to say you don't have to worry about too much, but they are a different way that you account for it. So just one to keep in the back of your mind. I think the way that I try to explain it to folks is that you can think of UTXO kind of similar to cash. So if you had a $10 bill, for example, and then you spent that and you got some change back, you'd have a new bill, you might have some coins to use. That would be your new transaction outputs that you then may use with a different transaction. Whereas the account model, if you use a credit card, right, just goes up and down. So slightly different to think about, keep in mind as we're talking through self-custody. So we've talked about how you need to demonstrate ownership. How do you even go about doing that? Well, you do that through keys, and this is where the crypto and the cryptographical currency kind of comes from. It's all about proving and demonstrating ownership through the use of keys that are secured through very complex maths and complex kind of processes that make sure they're safe and sound, without needing to turn up, demonstrate, put an ID forward, purely through just owning your keys. Typically, you have two keys to demonstrate ownership. You have your public key. This is the one you might give to your friend. This is one you might give to anyone who wants to send you Bitcoin. For example, this receives your transactions, and it generates an address that you can receive your transactions at. This is more like your email address. So it's public, you can kind of hand it out. It's how people can access you and find you. But it's matched by a private key. And this is the secure bit that you should never tell anyone about. If anyone has your private key, they could, in theory, use, access, gain access to your Bitcoin funds. And this is importantly the key that proves ownership. So ownership of this key demonstrates you have the right to spend the Bitcoin at a certain address. So it's more like your password. So your public key is your email address, and your private key is your password. That's known in the business as a key pair. So they are matched. They are cryptographically matched. But importantly, you can only go from one to the other. So a private key, using a very clever mathematical function called a trapdoor, a private key generates a public key, and you can easily go from the private key to the public key, but it's very, very difficult, near impossible to go backwards. So you can't have the public key and find out the private key. You can have the private key and find out the public key. So one thing to keep in mind, they are secured, they are a key pair, and this is how we demonstrate ownership. And this is the fundamental basis for cryptocurrencies and how you are able to use and manage them on the ledger. It's worth noting too that this idea of keys is no longer limited to just financial transactions. Increasingly, you might hear of the phrase called passkeys, which many websites are using to replace passwords. Exactly the same thing, very similar, using that cryptographically secured method of demonstrating ownership. It's easier, you don't have to remember stuff, but think keys, think Bitcoin keys, but also think passkeys that are developing. So we'll get into that a bit later, but there's a range of implications for having keys. How do you hold your keys? So you may have seen that keys are very complex. They're very long, randomly generated numbers. They're represented as alphanumeric for many people, but there's an example here on the screen. That is a key. Obviously, that is impossible to remember. That's impossible to write down. Indeed, it's probably not safe to write down for fear that you get one letter or one number wrong. You'd definitely lose it. So what we need to do is find a way to safely store, manage, and then use these keys. That is also the second part of the base of cryptocurrencies. Not only just having the keys, but also the storage of the keys. And for many years, when post 2009, when the concepts of blockchain, the concept of keys was developing, this was one of the most complex areas for many people. And many people actually lost their keys. And so you hear these figures about the amount of Bitcoin that is lost. Often this is because they have forgotten or lost some of the keys that they need to manage that unspent transaction output, or for common parlance, manage that Bitcoin. So you need to say, and importantly, as we said before, your private key is your password. You don't want to give that up. You don't want anyone else to receive that. So you have to keep it safely. You have to keep it securely, but you also have to make it accessible. There's two solutions to that. The first one is kind of easier, more common. It's called custodial. So let's say that you have gone to an exchange and you have purchased $100 worth of Bitcoin. That will obviously come with its own, address, that own transaction output. Many exchanges will say, don't worry about having to custody it yourself. We'll do that for you. We'll hold your keys on your behalf. And then when you want to use your Bitcoin, when you want to send it to your friend, when you want to sell it, tell us, and we'll do that on your behalf. So effectively, they custody your keys for you. In reality, a little more complex. Many exchanges won't actually custody the key itself. They'll have a big pot of assets, and they'll just withdraw the right amount at the right time. But you can think of it about them holding your keys for you. But there's a phrase in crypto called "not your keys, not your Bitcoin," and that's where self-custody comes into play. So let's say that you're nervous about an exchange holding your behalf. Let's say you want to hold your own money yourself. You can do that, but you need a way to do that safely and securely. So going back to that key pair function, often you have multiple of these for each kind of unspent transaction output on the Bitcoin network. Let's say you have 12 or 13 key pairs. Obviously, that's really hard to remember. You have to get the right key pair. You want to remember where it's going, but you want to do it safely and securely. People, understandably, we needed to make a solution, and the solution was what's called a self-custody wallet, or a big sort of, think of it as your wallet. It's a series and where you can protect and store your keys, and importantly, you can use them when you want. And that's also trustless. It's a really key concept in crypto and Bitcoin and digital assets, that trusted security model. You don't have to rely on anybody, any intermediary. You just have to trust the code. And you can demonstrate that, you can prove it. The keys are secured cryptographically. So it's a really important part of crypto is taking out that need to rely on your bank, to rely on those intermediaries, and you can rely completely on yourself. So we've talked about custodial solutions, talked about keys. Let's get into talking about self-custody specifically and some of the features of it. So as we said earlier, it's a wallet that stores the keys for you. You can think of it like a password manager. Let's say you've got a different password for all of your sites, as is like commonly suggested. You're not going to remember all of those if they're complex, but there are solutions on the market. Think LastPass, think 1Password, that not only store those really complex passwords that are more safe than maybe having 1Password, but also allow you to easily use. A self-custody wallet is very similar. It's a place to safely store all of those key pairs and for you to manage, access, and own them. There are different types of wallets to be aware of. So we have the concept of self-custody, but within self-custody, there's a few different sub-wallets. There's a hot wallet. This is kind of connected to the internet at all times. This will often just be a browser extension. I think MetaMask is a good example of a hot wallet. It sits in a browser. All your keys are in there. You can use it very easily. Because it's connected to the internet, it's called hot. The kind of reputation of hot wallets is, whilst they're very safe and very secure, obviously having that complete internet connection at all times does obviously open it up to potential for people to try and hack it, stuff like that. Hence why it's called hot. A cold wallet is actually a physical piece of hardware. So I have my Bitkey here, as you see on the screen. That's my cold wallet. That's offline hardware. So I only have to use it, bring it online when I need to use it. That is obviously safer. You don't have that physical connection to the internet at all times, but it does require a degree of technical expertise sometimes. Bitkey's trying to solve that, and we'll get into that. But that's called a cold wallet. And finally, you have a paper wallet. These are the original kind of standard people that did this. You literally write down your key pairs, you write down your seed phrase, which we'll talk about in a second. This is suggested not to do that. Easy to lose, and if you lose it, of course, you might have trouble getting those back. So that is the third option. But realistically, most people, when they self-custody, we're talking about a hot or a cold wallet. As we said with self-custody, though, you are taking responsibility for your funds. You are taking responsibility for your Bitcoin, for example, and therefore there is some responsibility with that. If you were to lose your key pair, let's say you lost your wallet, whatever happens, there is a way to recover it. It's called a C phase or a recovery phase. This is essentially a master key to all of the other keys in your wallet. It ties together all of those key pairs and ensures that if you did lose that wallet, you could recover it. It's kind of 12 to 24 words. It represents a long string of numbers. It isn't actually, you don't have to remember those numbers. You remember the words themselves. So there's an example on the screen about what a seed phase looks like. But importantly, this is a point of failure. If you were to lose that seed phase, if that seed phase was to be taken by somebody else, they could access all of your key pairs and therefore access all of your funds. So this is a sharp edge, as we call it here at Block, for self-custody. And there are some dangers to it, as the video will demonstrate.
In 2013,
let's try to get that video up again. Here we go.
In 2013, a British man accidentally threw away a hard drive. It contained 7,500 Bitcoin. Fast forward to today, the crypto inside that hard drive is worth more than $350 million. His name is James Howells. He's an IT worker from Wales. Over the past 8 years, he's been on a mission to find that hard drive by digging through his local dump. But so far, no luck. He once told NBC News, quote, "It is soul-destroying, to be honest. Every second of the day, I am thinking about what could have been." In a last-ditch effort earlier this year, Howells offered his local town tens of millions of dollars to help him find it. In a recent interview with The New Yorker, he said, quote, "I still hope and feel it can be done. And as long as I feel that, I will keep trying." The journalist who...
So that's a good example of what happens if you lose your seed phase. Unfortunately, that particular example, he didn't have it, and therefore he can't recover his funds. So it is a sharp edge, as we call it. So we'll come on to later some of the solutions about that. But I wanted to also quickly touch on why self-custody. Why do people even self-custody in the first place? Well, there's a few different reasons why. I think firstly, you remove intermediaries. You remove the people who have to maybe take fees, who do this on your behalf. That means greater control. So you have complete control of your funds. You can manage them as and when you see fit. And it also means that you don't have to rely on site outages, other things like that. You have total control of your funds at all time. Secondly, it's a bit more secure. So for example, if you don't have it on exchange, you're not subject to bad actors, you're not subject to hacks, and you remove some of that counterparty risk. So we've seen that famously with some of the 2022 exchanges who had bad governance. If people on those exchanges were self-custodying, they wouldn't have been brought up in some of those bankruptcy claims, but they had to rely on that third party. And anytime you rely on a counterparty, you're going to have some of the risk from it. So you also enhance security for your funds whilst taking away some of those risks from counterparties. Finally, it's also economically empowerment. So if you are denied a bank account, if you're denied other accounts, if you're underbanked, if you're debanked, for example, this is a way for you to still have access to financial tools, to have access to savings, have access to funds. You don't have to rely on somebody to give you an account. You can make your own account. That's really important. I think we see definitely here in the US, but also elsewhere, that people often deny bank accounts for many reasons that are problematic. And that's not the case. Here at Block, we're all about economic empowerment. And that's a big reason why we are supporting self-custody wallets. It's worth noting too, accessibility. So this is kind of similar to security, but it's more about you're protected from freezing accounts, you're protected from withdrawal limits. This aligns with some of the principles of digital assets, so decentralization, and it helps promote a more equitable and transparent financial system, especially. So it's key to think about that permissionless structure, the fact that you can access your funds at all times, and that goes hand in hand with security, really. And finally, privacy is super important. So, self-custody wallets in general can help to manage and ensure your funds are private. You can keep personal information safe and secure. You don't have to pass on stuff you're not comfortable passing on to third parties, intermediaries. And that goes for financial and non-financial tools. So we'll come on to talking about ID in a bit, but there's a world in which you could just show your age, for example, to demonstrate you are the right age for a product, and don't have to put, for example, use stuff like your address or other things like that. So self-custody is really important for all of those reasons. You can think of it as trustless security, as we came before. So that point that you don't have to rely on people and you can do it yourself, and you just rely on the maths that works behind it. So that's a real key point. I'm also going to quickly touch on the size and scope of the self-custody market. It's interesting and growing in the early days. So as you can see, the total market size is pretty large for custody. So it's about 8.42 billion in 2022. Growth projections about 24% per year up until 2030. Of that, cold hardware, so the kind of offline hardware, is a subsection, growing in interest. Most people use hot wallets if they do self-custody. Around 300 million for now, but again, large growth projections between now and 2029. As of 2019, actually, most people did self-store Bitcoin. This has probably changed. It was hard to get some updated figures as part of the 2021 bull run, for example, but the majority of wallets themselves are custodial. So most people, will have maybe self-custody, but they'll do it through a big provider. And the amount of Bitcoin is self-custodied, but the majority of sort of folks who own Bitcoin will custody with a provider. So a kind of difference, but one to be aware of. In terms of self-custody itself, it's a very competitive, diversified market. There's tons of options. There's many horses and many courses. Some of the big ones you hear about, MetaMask, Coinbase, Ledger, Bitkey, and Coldcard are kind of very popular. The difference is what security options they offer, so worth to be aware of that. And finally, there's a sliding scale of interest. The more advanced Bitcoin users will want to use a certain sort of self-custody, where the beginners might look at something else. So worth keeping that in mind. And we're going to look at some technological innovations in self-custody. I think there's some really interesting use cases for it to keep in mind. So it's not just Bitcoin. Self-custody has been around for 10 years, started the innovation process, many cool things that go on. I've got some ideas here. So, for example, where we talked about passkeys earlier, I think a big technical innovation we're going to see is going to be customer user experience. So APIs, seamless integrations, key recovery products, for example, making sure you have to do a seed phase, products for beginners. Storing tokenized assets will be a big one. Stocks, treasury bills, tickets. Digital identity, so streamlined KYC, privacy-focused information sharing, digital credentials, all can store in self-custody. Payment integration, so be able to spend straight from your self-custody wallet, as you do on websites for Apple Pay, for example. Remittances for folks traveling across borders. You can take your funds with you. You don't have to pay those third-party fees. Digital voting even, so Internet of Things integrations could all come down to your wallet. So it's early days, and I think there's a lot the self-custody market needs to do around refining user-centric design, building trust, building compatibility, and having killer apps that promote people to get onto it. But we think here at Block that we probably have, hopefully, the start of this, the first iteration of a product called Bitkey, which is our new self-custody wallet. And this video will quickly introduce what Bitkey is.
If you're someone who wants to protect your Bitcoin and who wants to use it wherever you go, so you can send and receive anytime, any place, anywhere in the world, and know that when you lose something, because life happens, Bitkey's recovery tools have you covered, just like magic. For security and peace of mind, choose Bitkey.
So that's Bitkey. Bitkey's a bit of a different wallet. So typically wallets often are what's called one key. So you have one key and that accesses your Bitcoin. Bitkey is a multi-signature wallet. That means you have 3 keys. You've got one key on your mobile app, you've got one key on your hardware device, and there's one key that sits on the Block server. You always need 2 out of 3 of those keys to move money. So the user's always in control, the user remains in control, and Block can never move funds without the user. But why do we do this? So I think that the unique thing for me, and what I've been saying this week in DC, is that because it's 2 out of 3, we can build unique recovery tools. So there's no need to remember seed phases. There's no passwords to lose or forget. If that example we talked about earlier from Wales, if they'd had a Bitkey, they would not be searching through their recovery, through their dump to find it. They would have had seamless recovery tools. And that's something you can do with this model. Secondly, 2 out of 3 means you can do daily use. Somebody can go on the go, they can use mobile pay functions up to a limit they set and secure with their hardware device in the morning. So I could send my friend $50 using just my mobile phone app with Block co-signing a transaction to get you up to that 2 out of 3 threshold. So making it more user-friendly, making it more kind of applicable to real-life examples. We integrate with exchanges seamlessly. So in the back end, you can go and buy your Bitcoin from Coinbase, from Cashapp, for example. That will sit in the back end. Those companies will do that process. They'll do the verification checks, but it seamlessly appears onto your Bitkey without having to remember difficult addresses. And finally, it's about the next 100 million users. So the UX is focused. It's easy to onboard. It's a seamless process. So Bitkey is a very exciting product for those reasons. I think the next kind of slide will talk a little more about exactly the specifics, and we'll get into that.
If you hold Bitcoin on an exchange, you don't control it. The exchange holds it on your behalf. If something goes wrong, you could lose access to your money. Now, there's a better way to own and manage Bitcoin. Meet Bitkey. It's everything you need in one wallet: a mobile app, hardware, and recovery tools. With Bitkey's mobile app, you can send and receive Bitcoin around the world and transfer easily on the go. And for added protection, you can set a daily spending limit on your phone, while your Bitkey hardware protects your savings safely at home. Use your phone and hardware together to approve transactions over your limit. And if you lose your phone, hardware, or both, Bitkey has tools to help you recover your money. Simply replace your device, follow the recovery steps, and recover your Bitcoin to your wallet. It's time you controlled your Bitcoin. For convenience, security, and peace of mind, choose Bitkey.
So that's Bitkey. It's a very cool product out now. Bitkey.world has all the better information. I'm conscious I want to keep some time for Q&A. So we kind of talked about those 3 keys earlier. We've kind of talked too about the on the go. I will just say that the recovery features means uniquely that if you lose any part of your device, so let's say you lose your mobile phone, you can recover that using safe, secured integration, cloud backup that is de-encrypted upon downloading a new app with your device. If you lose your hardware, that's also fine. You can get new hardware. And we have a process using customers, friends, and families, trusted contacts to recover that. And indeed, if life happens, if you lost both your device and your phone in a disaster, that's also fine. There's a way to recover that using your trusted contacts as well as your cloud backup. So it's really it's a fantastic process and removes those sharp edges for users. Bitkey, I think the phrase that we always say is it's easy to use and hard to lose. So that's unique. And one of the functions we're trying to manage for in this environment is bringing people on self-custody, encouraging them, offering them enjoy solutions. So a real key for that. I want to talk quickly too about the public policy implications of self-custody. I'm a policy guy, so if you did have questions on that, happy to talk about it. If you're in the US and you want to talk about Fit 21, of course, which is a big vote next week, happy to touch on that in the comments. But with any new technology, there's always new regulations, there's always new public policy implications for it. I think the regulatory interest is quite split, it's fair to say. It really depends. So I think digital assets is kind of a big conversation ongoing. We're talking about market structures a lot. Regulatory interest gets split a lot between sort of the EU has one approach, the UK has another approach. Some countries don't really care about self-custody. The debate in the US is more polarized, for example. And self-custody often gets put through these wider conversations rather than having a standalone conversation. So some key kind of things that come up often is market structure. When we're structuring our markets for cryptocurrencies, digital assets, what sort of risk management mechanisms should we be taking? What should that be included? What role does self-custody have in that? And what steps does it do to improve security? And what steps are we worried about as regulators? So, for example, consumer protection is there for managing that risk of hacks, but also are we worried about the fact that they may have to require a password? That was a big focus for the Bank of England in their recent stablecoin consultation. Obviously, AML, KYC is a big issue, a big topic of debate. Exchanges are the place to do that. The exchanges do the onboarding, they do the checks, they do the verification. They have the walled garden. Self-custody sits within that walled garden, and then in our opinion, it's not appropriate for them to be doing KYC, AML. It's simply a tool. The user remains in control, but there is a debate about how and when wallets can contribute or enable or work with exchanges to ensure there is KYC and AML. Taxation is a big issue. What does it mean to be a broker? We saw in the US, the IRS were of the view that wallets were a broker. We heartily disagreed with that. Wallets, the user remains in control. The user is responsible for effectuating their transactions. The exchange is the broker, and the wallet has no party to any transaction. So a live debate, but one that we think often is through a misunderstanding or misreading of the technology. And finally, privacy. Wallets have privacy enhancing features because otherwise you'd be able to very easily see on the blockchain the total picture of one's assets. So it's important to think about, what steps are we comfortable with privacy? What is considered too much privacy? What is, preventing from law enforcement others doing their job? And what is simply enabling people to have the privacy for their financial tools? You wouldn't expect anyone to read your bank account freely. That isn't a thing on the blockchain, by the way it's structured for its transparent nature. So how we manage that is really key. I think it's worth noting too that there's been a big growth in blockchain analytics firms. That really helps with kind of easing some concerns around wallets. They are pseudo-anonymous. They're not anonymous, as people often say. So you can draw links through these blockchain analytics firms. That's had an impact in reassuring, law enforcement, some of the national security folks about the risks of wallets, and also helps to make sure that bad actors can be, caught and managed, whilst good actors, everyday users, can have that privacy and be able to use their funds and control their assets. And that's kind of the key thing for self-custody. We're really in a debate of what is control right now. So at what point does control go from being a custodial wallet through to a self-custody wallet? Where is that line? What does that mean? And what are the implications for regulators and policymakers as part of that? I think if you're going to take one takeaway from public policy for self-custody, think about what is control is the main debate. And it's really important that we help to illuminate and show and demonstrate that self-custody is user control, and therefore has different requirements for them. There's not agreement on how to do this. So I'd say the US is a very partisan debate on not just digital assets, but self-custody. There's no legislation, although Fit 21 may pass the House next week. Let's see. On the one hand, you can kind of see the FinCEN 2019 ruling, which said that self-custody was not an example money transmission, that self-custody wallets were not part of that regulation, as well as the recent Coinbase and SEC case ruling, where the judge ruled that Coinbase wallet was not a broker, a really important case. But on the other hand, you see tax broker regulations I referenced, as well as a recent DOJ indictment of Samurai Wallet, which tried to infer or may suggest that Samurai Wallet was a money transmitter. So a very partisan interpretation of what is control and what does that mean for wallet providers, but also wallet users, importantly. The EU have actually regulated in this space. They took a risk-based approach, a risk-based and principle-based approach. So this is primarily through the travel rule, which is the transfer of information with transactions to manage and support AML. Wallets themselves are out of scope. There were some due diligence requirements put on exchanges or virtual asset service providers to verify and do diligence in their wallets. That was a sensible compromise and helps to manage some of the risk of those bad actors while supporting people's right to self-custody. And they're still to refine those rules. So we'll be working with GBBC and others to comment on them as that happens. And the UK is a very different scene again. So very early days, they're just doing their stablecoin consultation. They're looking at legislation in that space. They've been very positive so far of our conversations. I think they're more aware of some of the benefits of it, and less kind of bullish on the downsides that they see, and have signaled that that's been out of scope. So there was the travel rule, for example, had probably greater leeway for VAS to make their own judgments on. And at the same time, I think the Treasury came out and said they did not think there were significant risks. So very positive in that sense. Some key areas just to watch to close up before we open the questions is just, I would note a couple of things that if you're thinking about policy in the next 5 years, these are the key ones. We touched on control earlier, but very important about where that line is drawn. Functions, increasingly decentralized kind of technologies will challenge intermediaries. That's often how exchanges, that's often how some of the regulations are done. How will regulators respond to this? What will they think about it? And what new regulations will they develop with that removal of that middleman? Finally, that kind of thinks about principle or technology-based regulation. Are we regulating the underlying inputs, or are we regulating the outputs? Obviously, principle regulation is kind of the gold standard, but often can be hard to do, and regulators often rely on just technology-based regulation where they can't do the principles. So important to really follow that. And finally, public engagement. I think there's been a massive growth in recent years of interest and use of digital wallets, of cryptocurrencies. Will innovations reach critical mass? What does that mean for regulations? Will there be greater pressure on policymakers? I think we can see some of that pressure coming up in the US election. We've had some senators came out this week and vote in favor of a crypto vote that maybe traditionally wouldn't be. Is that because the electorate is more interested? Is that because the electorate is putting pressure on? So interesting to see the public engagement area. That was all my presentation. I know there's some time for questions, so welcome any and all of those.
Thank you so much, Will, for a really fascinating presentation, especially when security is such an important issue. We appreciate your insights, you sharing your insights about self-custody today. I'm Diana. Again, I'm head of research and sustainability at GBBC, and I can take questions, out of which we have a number submitted from the registrants beforehand and a number that have come in just now. And the first that I want to start with is, how can Bitkey prevent hacks? For example, yesterday there was an article that came up on scams, schemes, and hacks. On May 16, 2024, a $1.7 billion hedge fund was hacked for an unspecified amount in crypto assets, and the perpetrators were not arrested. In cases like that, how can Bitkey be a potential solution?
Great question. I don't know that particular case, so I don't want to comment on the specifics. And I would probably note that in that scene, that's an institutional custody solution. So I don't know how they're custodying their assets. I think on a kind of, you know, a retail human level or kind of personal level, what stuff like Bitkey and other self-custody wallets do is they remove what we call the honeypot problem. So if you have all of your assets, let's say, 100 people will put their assets into the same pot. So let's say exchange Y has all of your assets at once. That's obviously a lot more attractive for bad actors. If you get access to that one kind of pool, that one pot of money, you can then take it all at once. If you're all self-custody, you're all kind of using your own funds. It's a lot harder for somebody to target 100 different wallets, for example, which typically may be offline, maybe safe and secure, than it is to go after a single actor and all of that kind of interest of having that big pool. So self-custody sorts of helps to decentralize and to put out the assets across many different areas, which helps with security. Can't come on institutional stuff, but I know Bitkey is a safe, secure method, supports users in managing those funds and having the peace of mind that their funds, their keys are secure on their hardware and that they can use them as and when they want.
Thank you. Next question is, do you see the demand for self-custody, as in Bitkey, will be predominantly for individuals versus institutions and smaller amounts rather than multi-millions and millions and institutional flows? So what size and whether retail or institutional?
It's a good question. I think if I look at let's take individuals first. So individuals, I think often will probably choose to, apologies. I think individuals will choose to custody any kind of size of funds. I don't think they'll rely on a third party if you have multi-millions. I think they'll use a range of different self-custody tools. I think they might change their wallets. They might use one wallet for everyday spending. They might have that wallet because it's easier to use for mobile pay, and they might have a wallet they consider more secure, more offline for other sorts. So you might have a hot wallet for spending every day and a cold wallet for storing lots of those funds. In terms of institutions, we know that many institutions do self-custody. The self-custody scene for institutions versus people is very different. The way you do it is obviously more professional. And if you are let's say you are a third-party exchange, you're a third-party hedge fund, you're often custodying on behalf of others. So you might self-custody, but you're a custodial solution, at which point you have certain regulations and requirements about how you do that. So I know that people, folks who do that do use self-custody, do have cold wallets, and they'll often have a hot float to manage some of the incomes and outcomes. So it will be increasingly kind of used. It's one of the safest ways to manage and own your Bitcoin, own your digital assets. And I think there's a range of options for both kind of retail as well as wholesale investors about how to do that. And again, as I said earlier, we're at the start of a technological innovations here. It's a range of opportunities, and there will be increasingly tailored tools for every kind of sector, every segment of the market. So I'm positive on the future of self-custody, and I think it's going to be a big part of the answer to many of those challenges.
Building on that, on the retail side, in a way, how is Block working to make Bitkey affordable and reach everybody?
Yeah, great question. So right now we have the one product. Here at Block, we're about economic empowerment, and we're always looking to think about how to get us in the hands of many people as possible. I think that what I would say is that we're global, so we are in 90 plus countries, so we're very aware of different markets, different market segments. I think one thing that got us really excited was the opportunity to work not just in the US, but in countries where there's different use cases. We've seen kind of feedback from folks in South America, folks in other countries where inflation is pretty high and pressing, or there's a less stable government, or they want to send remittances. The products like Bitkey, it makes it easier and more accessible to do that. So the team are always looking at options, always considering the next steps of the product. This is the first one we've launched. We're going to get it into customers' hands. We're going to get it out there in the world to refine. And as we go through this process, as we go through self-custody, as stuff like Bitcoin and stablecoins as a whole become more popular, I think the self-custody environment will become increasingly accessible, increasingly considered, a one-off purchase maybe to help secure those funds. So I think it will come with time. And here at Block, we're focused on, making sure that we, get this product into the hands of as many people as possible, and make sure that it's as global as possible at the same time.
Talking about regulatory requirements or even country by country requirements, how would you deal with differences in requirements across different countries? And this could actually be two questions in one. And what are your comments on global coordination on the regulatory side?
Yeah, I think the global coordination piece is really interesting, right? We have folks like FATF, the Financial Action Task Force, who do try and think on that global scale. I think there is a coordination issue. We've seen the G20 and the G7 try to address it, but everyone has a different take on the right risks, the right approach, the right legislation. I think that makes it harder to innovate, and we've said that to kind of states we talk to, that a globally orientated solution, globally principles, are really helpful. But everyone will take their own view on their risk they want to take for their market. Here at Block, we engage. We're a multinational company. We engage really productively with all of those markets. We appreciate that there's different horses, different courses, and that the way that the EU regulates, for example, and the way that the UK regulates is very different. And what we're here to do is educate and work with those policymakers. We want to give them the resources, the options. We want to be in the room talking to them to make sure they can, make those judgment calls. Hopefully, we can also use some of that multinational to make best practice. So, we work really robustly across those markets and make sure we're compliant with all the requirements that we need to be. But I think there's a real piece for bringing that insight from what's worked and what doesn't work, and offering policymakers that kind of background so they can make those judgment calls, which I think we try to do here at Block at the policy team.
Excellent. And can you speak further on the future of adoption of stablecoins and self-custody solutions?
Absolutely. I think that's one of the most exciting use cases, right? Obviously Bitcoin is we are a Bitcoin first company here at Block, and we're very excited about that. I think Jack in his recent shareholder letter set out, our vision for Bitcoin. I think stablecoins is a real growing part of the market. Obviously, it's you don't have to think about the kind of changing price of Bitcoin, which may be a better long-term store of value, for example. I think self-custody solutions will adopt stablecoins increasingly. You will see increasingly people who will want to spend that at retail in everyday examples. I think we'll increasingly see folks who are comfortable with having their self-custody wallet at home, setting their limit, going out and spending that in the world, using their stablecoins to transact. I think the obvious use case for a self-custody wallet in this case is remittances. So, for example, I'm going to the Cricket World Cup next month in Barbados. Anyone else who's a cricket fan, shout out. Maybe a world in which I want to spend, I don't want to have to spend fees to transfer money. I'm worried about the exchange rate. all the unfair thing that makes people lose value too. There's a real world in which I could, bring my self-custody wallet, have my stablecoins on it, and hopefully spend that freely and easily, having, gain a benefit of that. So it helps with that kind of transmission. It removes those fees, and increasingly people will become confident in the way that they use their, Google Pay, their Apple wallets. I think self-custody is the next way to do that in a way that's, more safe, more secure, and more accessible, and increasingly will become a one-stop shop. So it won't just be stablecoins. It will also be your digital ID, your digital credentials, your decentralized identities, even your tickets and your password on your passwords. So self-custody is a real growing technology. We've got to make people comfortable with it. We've got to make people aware of it. But there's a whole range of use cases, and we've just scratched the surface. So exciting time to be in self-custody area.
Well, wonderful. We are out of time now. And thank you so much to Will and to Block for joining us today. It's been a very thoughtful and engaging presentation and Q&A on self-custody and also all the complex considerations around it. You explained it so well. We look forward to learning more about Block's progress, especially with this product. There's so many opportunities ahead. A recording of this presentation will be circulated to all those who registered and also shared publicly on GBBC's YouTube channel. Thank you so much and enjoy the rest of your day.